This is more or less what you can find when you look for trading education or anything related to your growth as a trader in the trading environment. We have expert advisors, forex generally, price action, social or mirror trading, which I spoke about, technical analysis, and psychology. All these are part of something that is promoted as the solution to all of your problems. Expert advice, let's start with this. You probably find offers for this, so you may be interested in getting some. And here we have two possible categories. You can purchase an expert advisor, or if you are a programmer or good enough programmer, you can develop it yourself. What are the points here? When you purchase it, if you obviously you do it based on the results that are promised from the vendor, and normally if these results are too good to be true, it's just because they probably are not true. And this is pretty obvious. I showed you real equity lines, and that is what happens, not what you see on the vendor side. And another thing is that when you buy this thing, you normally don't know what the code looks like. It's just sort of a black box, something that does something, you don't know exactly what. It's a black box. And this is not good, because you never know if it is exactly doing what it is expected to do. Good or wrong, we don't mean this, but you don't know if there is something wrong in the behavior, because you don't know how it should really act. And most often, to make it appear nice to sell, it is full of overfitting, which means the system is built to fit as good as possible the past data. So they tweak everything to show good results on what happened in the past. And it has been tweaked too good so that in the future it has nothing to do with the market. It's just something that has been built on past data, trying to match every single move to show good results, but not really the market behavior. If you develop yourself because you decide to do what I do, you first thing to be careful about, you never have to fall in love with your ideas. Be careful, because this is very dangerous. Normally, when you have an idea and you believe in this, when you build your trading system, your expert advisor, your software, whatever it is, you build it, you test it, and for some reasons, you see that the results are not as good as you thought. Normally, you, but me, everybody here, does not accept the reality. You don't accept that what you thought should be so good is not that good, and you start trying to tweak, change, adapt. You try everything to convince the machine to show you good results. And this is a problem, because normally it's much better to dedicate your time to develop a new idea rather than trying to get a bad idea become good. This is something which is very true, because especially in the path of getting something bad into something good, you miss the fundamental stages of development and you get tricky. Once you developed a system, you should see a decent period of live trading. What I normally do, or I did, now I'm a bit shorter because I have many systems, I developed a system, I forgot about the system for 3 to 6 months, and then I took the system back and I checked what happened in those 3-6 months. Also, I looked at the system trading live on a demo account to see if the trades were really those that were supposed to be placed. Because not always the system does what you think it should do. For many reasons. There are bugs in the software, bugs in your code. So you have to check that what has been programmed is doing what you wanted it to do. This is very important. And when you see the results, you have to be honest with yourself. In many software, good software, there are bugs that lead the results to be false. For some reason that you cannot even imagine. But if you are aware of this, don't start cheating yourself saying, oh yes, I know that in this case it would not work, but this case will never happen. It happens. So if you have results that are really nice, accept the idea that there might be some bug somewhere that changes the real outcome of the strategy. And you notice that in real time, but when you place real money on that, it becomes expensive to check. So it's better to be honest previously and say, yeah, but I would never be able to buy exactly on the open because it's too volatile. If you have a trade that has a strategy with an average trade of, let's say, 2 pips, for example, okay? And it's supposed to buy on the open of the market, you know that these 2 pips are not assured anyway. So you have to be honest and say, yes, it's very nice, but probably those trades will never apply in reality. This is very important as well. Then about Forex, here is the guy who, what the industry shows you is a very nice scenario. They make you think that it's a breeze, it's really something easy to do. Just click left and right, you make money. It's what you see. In Italy, we have spots with happy people showing their face. I just earned $5,000 extra this month just working on Forex. Oh, very nice. Now they changed a bit. It was on Forex. Now they go on binary options. But the concept is the same. There is nothing that easy out there. They claim that you can make big profits in spite of small capital just because they say you have a high leverage possibility. They state it's easy to keep under control. You just click here, you click there, you place the stop loss, everything is so easy that a kid could do it. They again stress the power of leverage, and it is open 24/24. They say, you have a full-time job? Don't worry. When you get back at night, you just have a quick dinner, and then you can trade till midnight, or even till 2 o'clock in the morning. Doesn't matter. They forget to say that in that time the market does not move very much and you probably can't do anything decent in that time. But they claim that it is. And many other things. The facts are a bit different. Some are bad, some are good. First thing, as we are talking about automated trading here, the backtesting has no stability in Forex because changing the data provider, you might change the results. There might be small differences, but they might play a role. This is an over-the-counter market. So there is no official circuit where the prices are unique, such as on futures or on stocks. So actually, if you test your trading strategy with Dukascopy data, and then you trade on TMS, you might have different outcomes. Maybe better, you are lucky, or maybe worse. But you don't have the stability you need. And, which is much important, leverage is dangerous. I hope you are all aware of it, but forget to become rich with $1,000. It's impossible. You better buy a lottery ticket. The point is that leverage is crazy because they always show you positive examples, but the opposite can be true as well. Somebody claims that your account will never go below 0. But when it happened, they claimed the money back with the lawyers. Swiss franc, 15th of January 2015. These things happen. So when something very bad happens, you are no longer on the safe side. There are anyway also futures positive effects. The high liquidity. The volumes are very high, and this is an advantage because you don't feel yourself in an empty room. You can diversify. You have many pairs. So you can diversify on markets that you wish, depending maybe on also macroeconomic scenarios that you have in your mind. You can build intermarket strategies with Forex pairs. And this is the most important part on Forex as well as on CFDs, that you have a high flexibility in position sizing. Here the leverage is important because on Forex you have lots, mini lots, sometimes micro lots. Having this, you can trade as small as necessary. And this is the most important thing. So it's true that if you have a small capital, you should trade Forex. It's absolutely true, but not because you get a huge leverage, but because you can trade smaller. You have a small capital, you can trade small. What you cannot do on futures, of course. Because futures, you buy one contract. You cannot buy 0.05 contracts, for example. It's impossible. Price action. Who follows price action here? You go out. Price action has some good basis. I mean, the principles it is based on are certainly positive. And the more you use it, the better you become. Because actually, you learn about many things, and you learn from mistakes and so on. And it's very useful to keep in touch with the market, because you are always there to study the moves, to study the reaction. So you are really, you become one with the market. So from this point of view, it's very positive and a very good approach. But, sorry, this is this one. Normally, when you measure the offers of the market, of the gurus, you find many cherry-picked examples. Examples which show beautiful outcomes, but they never show the really bad outcomes, which are there. They tell you things that, at the end of the day, are only the good ones. The bad ones are hidden somehow. And after, it makes much sense. That's why it's so interesting, because you look at the site, you read the principles behind a trade. That trade is already closed. That trade was very nice, but would you really have traded that way in real time? This is the big question mark. And I can tell you that the gurus of price action are seldom real traders. They claim to be, but if you carefully listen to their words and you carefully analyze what they say and they say to do, you realize that they are not really trading, because they are missing some particulars that only a real trader has in his mind. Only a real trader knows some things that happen when you are practically placing the trades, and they always ignore this. And the only answer to this is that probably they don't really trade. It's very easy to teach, because you can demonstrate anything, but it's very hard to learn. Even when it shows to be very clear, very outstandingly clear, then when you sit down and you try to do it yourself, you start having many question marks. Because it's not as easy as they claim to be. In fact, here, for example, look at here. Here we have moving averages, okay? Downtrend, pullback to the moving average, and here an engulfing bearish candle. This black candle here is an engulfing bearish because the body eats completely the body of a previous white candle. This is a price action setup for a short entry in case of breakdown to the downside, with stop loss above the setup. The price action guru says that he enters short here after the breakout on this long black candle, and down here he has a weekly support which he takes as a take profit after a pullback from a monthly support. Let's imagine it is a support, okay? Now looking at that, you say, oh yes, it makes sense. I have this pullback, it stops exactly at the moving average, I have a short signal, I enter, and look at here, astonishing, it really touches the monthly support. It's sort of millimetric precision. This is my way. Yes, it's true, but what would you have done here when you sit in the trade? You are scalping the markets. You are afraid of giving the profits back. I remember you were talking to me when we were eating. Would you have been quiet there? I doubt. But myself, I would probably have been afraid here. You have these wonderful gains immediately, in 2 days. And then you see everything going back. The price guru actually says, oh, look at here. It stopped the gain of a moving average. It's it's a powerful tool. But are you still in position? I don't think so. And so on here again. Then here, it goes back up. Maybe here you would be waiting because you say, now I've seen so many pullbacks, this is another one. So actually, the point is that even though it makes a lot of sense, now after that we know how it developed, it is so difficult to follow it when you are in the trade, but I really don't recommend it. So if you are profitable using it, it's fine. But if a new buyer wants to learn it to become profitable, I tell you, stay tuned. It's very difficult to be learned in a profitable way. Don't waste your money, because he's trading price action. By social or mirror trading, I just talked about that a little bit during lunch. Advantage is that it has a reduced activity. You have just to subscribe to somebody who takes care of your account, and you use his skills, so you take advantage of our skills. And if you refer to somebody who offers different potential gurus, you can be flexible in jumping from one to another. So everything seems to be nice, but normally it is expensive. Either you have larger spreads, or if it's on futures, you pay higher commission. So as a follower, you normally have worse conditions than the leader. And this is pretty normal. Somebody has to pay for it. And normally, it is very risky, aggressive, because one requirement is to trade this with small accounts. And especially on futures, it becomes automatically aggressive because I trade on a small account with the standard stop losses that I have, and these become heavy for that small account. Small accounts are needed because if I want many followers, I have to place an offer where you can open an account with, let's say, $10,000. I can't ask you to follow me with $100,000 because I would find few followers probably. And also in this case, the past performance are normally too good because they are based on backtesting, not on real trading, just to be more, to be nicer for the people who want to subscribe. And again, you are not trading with your own stuff. You follow somebody else, and you don't know how the situation is. So if you are in a drawdown, you don't know if that is normal, how the guru feels. You don't know, because you are just there, seeing your money jumping on your account with trades placed by somebody else. Oh, technical analysis. I told you before that I'm in the scientific committee of the Italian Society, fine. And I think, again, like price action, the technical analysis is good to study the market behavior, absolutely good. And it's also good to feel the market again, because you study maybe day after day a development of the courses. So you get actually a feeling on how the market behaves. But I think it's nearly useless to trade off. Because again, you have a lot of information or scenario, but what to do really is not that evident. And I believe that most of the specialists don't really make their living out of trading. Normally, a technical analysis specialist is somebody who is hired by a fund or an institution to write reports about the markets, but that's it. And their trades are normally not placed following the reports, but it's just something to produce paper. Because the truth is that if you put everything together, you don't know what to do. You can draw as many things as possible, but you don't know at the end of the day what to use and how to use it. Psychology, we will have a deeper look into this. It's good. I mean, you need to understand how you behave and so on, but you don't have to get crazy because of it, because you have always to put everything at the same level of importance. In terms of psychology, the problem is what our expectations are when we start trading. So first of all, we try to understand the market so that we benefit profiting out of something which we understand. And we try to find a compromise between our private life and trading. If you have a 9-to-5 job, you cannot imagine to become a scalper. It's nearly impossible. You are in office, unless you trade from your office, which probably leads you to lose your job, so you solve one problem. But it's hard to do it. And this is the most important thing. We have to try to understand if trading is for us. There are many people, believe me, who should not trade. I know I should not say this with a broker organizing this, but many people should not trade because there are a lot of evidences that they will never be profitable. People insist, they think to come out as winners at the end. Losers never quit, yes, but lose or also die. So I think you have to really look inside yourself and try to understand if trading is something you can do. If you can't, it's not a problem. There are so many things to do. You're not worse than anybody else. If you feel that trading is not for you, just quit it. It's cheaper. The point is that you should not imagine this from your trading experience. Because this is what people tell you, what people who sell courses and so tell you to look for, but it's not what it was. Imagine when you lie with a computer on the strand, on the beach, and sand comes into your computer. It destroys it. It's not something that is very, very useful. But you have also to equip yourself duly to avoid desperate situations, of course. But again, be honest. Because when you study, you start feeling invincible. And you think you are the blonde guy up there, and the market are the lion. And you think to be in control of the market, you think to be a friend of the lion. This is what we are all normally led to think when we start learning trading. And at a certain point of time, we believe that we got in touch with it and we became the friends of the lion. The problem is that this is what happens normally. And this is true. I know many stories, so believe me, it's better to avoid a situation like that, with or without lion. Now let's see what a trader is. Trading in general has a part of discipline, psychology of course, technique, you have to have some ideas of course, money, you need money to trade. If you have $1,000, you can trade, but you cannot make a living out of trading, which is sad but true. And money management, position sizing, which we will detail. Inside you have Dr. Jekyll and Mr. Hyde as a trader. Dr. Jekyll was the good one, and he normally sees what's happening, what's going on in the markets, in your account. He's realistic, and he doubts about himself. He recognizes that he made something maybe not precisely correctly as it should be done. So he recognizes his faults. He wants to apply a stop loss because he knows that the stop loss can save his account. And he wants to plan next trade because he knows that planning the trades and following a plan is much better. Then there is Mr. Hyde. And Mr. Hyde feels innocent about losses. So, oh yeah, but. Yeah, I lost, but. There's always a but. The funniest but is the market which goes wrong. I was long and that stupid market went short. Are you sure that it's the market, the stupid one? But he thinks really that the market is guilty for that. And the evil broker who knows where your stops are put and goes and catches them. This is another legend of Mr. Hyde. They always see these brokers which spend their days in looking where the stops are placed to catch them and wipe out your account. But they lose a customer. I don't think it's that smart actually. And then he leaves trades open, hoping they get back into profit. And this is bad. Hope is your enemy. In trading, hope is an enemy. I said I was to place a stop loss. You need a stop to stop a trade. Don't hope to see the profits back. Mr. Hyde, you have to get rid of him. He wants you to be undisciplined. So you have to fight this. Analyze your trades. The bad and the good ones. Analyze them. Plan your activity so that you don't have to decide when you are sitting in open markets. Use resident orders, so place stop and profit or entry into the server of your broker so that they are sent without clicking the mouse when you have to enter. You place them earlier based on the plan that you have. The best thing you could do is to plan everything, place the orders and just forget about it. Close everything and walk away. That would be the best thing to do. I know it's difficult, But if you believe in your plan, this would be the best behavior. Mr. Hyde don't want you to trade with a plan. But now imagine, it's already difficult to decide what to do now that you are here, sitting here calm. But imagine when you are under stress in the market, open position, in loss, in profit, you don't know. How can you decide in a clean way what to do? You are deeply under stress, and you probably make mistakes in decisions. Every event has to be planned. You have to imagine what can happen, all the things that can happen, and prepare a decision on what to do if this, and this happens. It means that the markets have to be studied before trading, not during. Don't think that you are so talented to sit down, look at the candles forming and knowing what to make. There might be one here somewhere, I don't know. One of you may be that good, but all the others are not. So don't try to do that. When trading is over, you can look back into markets, but just to reanalyze the decisions you made, and maybe you can improve for the next time because you made mistakes, but also in the good trades. When you make too much money, think about that because maybe you were overexposed. Maybe you had too large a position and you were lucky because it went in your direction. But think about it. Analyze everything. Mr. Hyde points on your greed. He wants you to become rich very quickly. He claims that you are becoming rich very quickly. And the worst thing that can happen to a trader who starts trading is to make some winners in a row. Because when you do that, you feel invincible. And automatically you start risking too much. Because you really start thinking that it is so easy and you are so good. But afterwards, the market will win. But it will be too late because you will be already overexposed. So you're risking too much. Mr. Hyde wants you to risk too much because he claims that if you trade big, you will win big. He omits that you can also lose big. So risking too much, I don't say it's right or wrong. It's not trading. So risking too much is gambling, which might be fine. I have nothing against gambling, but you have to be aware that if you risk too much, you are no longer a trader, you are a gambler. Being a gambler can be positive if you want to be, but it does not apply to trading. It's better to become rich slowly than poor very quickly. But believe me, this is difficult to grasp because you always think about the two ways to go in the same speed. But actually, if you think at plans you had maybe 10 years ago, and how you were thinking for your future 10 years ago, and now you look back and you say, oh, 10 years have already passed so fast. But now, if you think it's something that will become true in 10 years, you say, oh, all that time. But you have to be aware that those 10 years pass very fast, very quickly. So actually, plan your growth. Don't be afraid of the time it takes. Plan it and step after step, follow your plan. And remember, again, going back to the industry, that the best trader in the world can lose the trading World Cup. Simply because every trader can lose. The World Cup, a competition, is traded with a high level of risk, which is not applicable in normal trading. So with that high level of risk, everybody can find a losing strike and go bankruptcy in that account. And the worst trader in the world can win the trading World Cup because of some lucky trades. He can make so much money that he will never be reached by the other competitors. So this means that the winners of a real money contest, even worse, a demo money contest, a real money contest, are not necessarily the good ones to look at. Okay? So I might tell you tons of bullshit. Don't say, I will listen to Andrea only because he won. I won 4 times, which is better than 1. But always be critical to anything you listen to. Don't believe to anybody before verifying. This is very important. Now, I told you more or less what you should avoid to do. Now I want you to show you something. I have many styles of trading, okay? You will get access being here to the course, and there I will explain a little bit of the main types of strategies that can be built. One way I trade, I'm curious. I look into markets. Looking into markets means, in my opinion, from my point of view, to simulate trading activity. We are the econometric experts who study complicated things, Garch, I don't know, autocorrelation, all things like that. They are certainly right and with a deep knowledge inside, but the point is that if you study all these complicated things, at the end of the day, with the results you get, you still don't have anything. Because then you have to interpret the results and know what to do next. While if you study the market simulating trading activity, I buy here and I say here, what happens? I buy here if this happens and I sell here if this happens. What happens? At the end of the day, you measure your hypothesis with money results, which is the reason why you are doing that. You want to make money in the markets. So if you measure the result of your idea in terms of gain, you immediately have the answer you are looking for. So all I do is to study the markets, simulating trading ideas. I always investigate what happens in a market in different conditions. One thing I do, for example, I think that the markets are not always the same, which is pretty simple and easy, but what does it mean? It means that, in my belief, there are periods of the day, of the week, of the year, where there is a higher chance of seeing a bullish behavior or a bearish behavior. This happens. All we have to look for if it happens stable enough to take advantage of. Let's study an intraday behavior. How we do this? We take, for example, euro, US dollar. Here I don't have it written, but it's. We can represent the market in different time frames. So we can imagine, for example, to represent our chart on hourly bars, okay? Which is, I suppose, clear to everybody. So every bar represents the trading activity between a certain moment of a day to the next 60 minutes. The bar what shows you what happens from 2 to 3, from 3 to 4, from 4 to 5, and so on. Okay, so what I could do is to make a simulation of what happens if I bought every day at the same time, exiting 1 hour later. For the period of time I have access to the data. What would have happened if every day, starting in this case with TMS data 2013, but you can get other data in longer period, what happened if every day I bought at 2 p.m., closing my trade 60 minutes later? Okay? Which is not a strategy, it's just an investigation of what could happen doing so. I do this running an optimization throughout the hours of a day, and this is important. Don't sleep now. Optimization. The bad news is that every software calls the tool to loop through a number of inputs optimization. And the standard user is pushed to use this as an optimizer, trying to find the best solution to something, optimizing. The truth is that you should use the optimization tool as an investigation tool, just to run easily through a number of variables, not as a way to look for the best thing. Then you can do it to fine tune and so on. But as a starting point, remember that using the optimization tool, you can evaluate a number of scenarios much faster than in any other case. In this case, I would have run 24 strategies for every hour of a day. With one optimization, I run through all of this. I think the concept here is clear. I use optimization here only to run through the different hours of a day. And then, having done this, we look at the yearly behavior of our outcome to see if there is consistency. Let's imagine, for example, that you run the test. You're sitting here, I have finger pointed at you, sorry about that. You run the test and you find out that you would have made huge... You don't want to listen anymore. You run the test and you find out that you made huge profits from 2013 to today, buying at 2 p.m. and selling at 3 p.m. Just any day, okay? I got it. Then you look at the equity line of this strategy and you notice that you made all the money in 2014, for example. If this happens, I would not consider it very much, because it would mean that for some reason in 2014 something happened that made you make a lot of money. But there is no consistency. If, on the contrary, the money you made with this simulation shows to be more or less the same year after year, then it means that actually there is something in the market that from 2 to 3 leads the market to go up. And this is something we have to take advantage of. I'm not using an indicator here. I'm just studying if I'm looking for in the market if there is something that I can use. Is there something in that market that shows that it is likely to do this in this period of time? Yes, no. If there is, I study further. Let's see. Obviously, once you build this, you can then add additional conditions to improve the results, but it's something we will discuss about. Okay, this is the optimization report. Be careful, one important thing. You are all here TMS customers. This is run on TMS platform. If for any reason you decide to change broker, shame on you, don't change TMS broker. But if you did, for some reason, remember that MetaTrader brokers host the servers in different parts of the world. And if some servers are in Frankfurt, it's different if they are in Cyprus or if they are in Moscow or in Singapore. And MetaTrader has the disadvantage to show always the time of the server as the time of the chart, okay? So what happens here with pass number 9, which is buying at 8 and selling at 9, for example, would be different if you measure this on a Singapore-based server, because 8 o'clock on that server is completely different than 8 o'clock here. There are 7 hours difference from here to Singapore, you know? More or less, things. No, 7 hours. 6 or 7, depending on the daylight saving. Now there are 6 today. You can check. I want to be sure at least not to tell you anything wrong. Singapore, it's 10:50 in this moment. 6 hours. What happens between midnight and 1 o'clock in the morning, which is the first row, happens in that moment. So obviously it will be different from midnight in Singapore. I think this is pretty obvious. Euro US dollar is the same here and there. It doesn't change. The time changes. So be careful about that, because you have to always measure it the right way. And also, be careful if you trade with other kind of software, for example, TradeStation or multi-charts or TradeStation or multi-charts, because I'm not sure you're aware of that. MetaTrader has the timestamp on the start of the bar. So 8:00 is the bar from 8 to 9, while TradeStation, multi-charts, and all the other software have the time on the close of the bar. So 8 is the bar from 7 to 8. So again, be aware of that in case you try to change software or to do other kind of investigation. As you have history here from 2013, you might consider to run a wider test on TradeStation, which you have a history from 2006, I think. And you might decide either to import the data here or to run the test there. So be aware of the timestamp, because there is the difference. You have to be aware of it. But if you don't, you make a, in Italy we say casino. We get more information from the histogram here rather than from the table. So what do you see here? Remember, we simulated hour after hour what happened if I bought at the beginning of the hour and sold at the end of it. Both. So I simulated from April 2013, when the history is available on the platform, to today. Long trades of a duration of 1 hour, from midnight, 1 o'clock to, and so on. So this is the result of trades of a duration of 1 hour, long trades only. So what do you see here? Next time you have to serve more coffee before the speech. Now I arrived here now, okay? I arrived here. I made this investigation, but what was the purpose of my investigation? I was looking for something. The question is, do I have something here or don't I have anything? I have. So please come here and explain. No, but you are using price action, so you are a tricky guy. What do I have here? You see that most of the time I'm losing money. It's true. Sort of an idiot, losing a lot of money. No, actually, that's fine. But why were I losing money? Because I was buying. So I already imagine that selling I would have made money. First information, okay? Normally, if you say, like a joke, if you have a losing strategy, do the opposite and you will make money. It's not that easy, but it's a joke, but it's evident. Buying, 1 hour duration, I was losing money. But what is really interesting here? What is really interesting? Why am I showing this to you on a cloudy Saturday afternoon, which helps falling asleep? Why this and not, I don't know, cable or Euro-Japanese yen? I don't know. I have not investigated them. Cable I did, but it's not that good. Of course, this is obvious. You have always to be careful about the time of the day in placing your trades because of many reasons. For example, again, if you use DAX, trend following, intraday breakout, it's useless most of the times to place trades before 10:30, 11 a.m. in the morning. You have to wait for the market to develop. If you place breakout trades before that time, most of the time they are useless because the market is dirty moves. And I can tell you it's good to stop trades at around 2:20 and to place trades again from 4 p.m. to 5 p.m. and then that's it. Wait to the end of the day to close eventually open position on DAX, for example. So there is, in any market, a time window where it is better to place a certain kind of trade. This is the important information. Use it if you trade intraday. Remember that there are times of the day which are more useful. But here, what do I see here? I'm not trading a breakout. I'm just seeing this chart. But this chart has an important information. The first thing that I look for and say, oh, look at here, this is interesting. 5 p.m. is interesting. Why is 5 p.m. interesting? Who was mentioning 5 p.m.? What's a drawdown? Where is the drawdown? There are no drawdowns. This is only the net profit. So it's 5 p.m. What are we going? What do we have to do at 5 p.m.? It's Saturday. Market is closed. Long entry. London market on Saturday. Or maybe we find an interpretation. This is. I can tell you also many things about this, but whatever the reason, if there is a reason or not, we have to define later once we see the next step. But here, obviously, imagine I will help you. Shall we buy at 5 every year, every day, for every year, and sell at 6? Is this our strategy? Of course, yes, no, because he imagines that the answer is no. Why not? Market is changing, so why are we studying markets? It's useless. If market is changing, it's true, but if we think that it's changing so much that we should not apply what we find, we should not look for anything. Right? Market is changing, the world is changing. Today, nowadays, this is not politically correct, sorry about that, but we have seen an increase of gay couples and gay child adoption. It's true. But who was looking for a girl or for a boy, if it was a girl before, is still looking for a girl or for a boy? And not just because there are more gays, you stop looking for a girl and you look for a boy. Unless you are one of the gays, but this is your choice. I mean, the world is changing, and in some cases it's better not to change with the world, but not just because it's changing, we stop doing what we did before. We have to try to see if here there is something we can do. The most evident thing, first of all, you have a bias, a wrong bias, because you saw the peak at 5 p.m., okay? You saw the big bar, okay? So here I have a big bar. I like the big bar there. But we have also big bars here. But these are negative big bars. But they are even bigger than the other one, maybe. I don't know now exactly. Yes, they are. They are bigger. That's less than 8,000. Here we exceed 8,000. Let's imagine we like the big bar up there. Shall we buy at 5 and sell at 6? He says no, he doesn't want to do it. Because he lives in London. London is closing. He wants to close. Why buying at 5 and selling at 6 is probably not our ultimate solution? Not the problem of probability. I didn't hear the other answer. Come on, don't be shy. You are not registered. Nobody will tell at home if you said anything here. Oh, here he is. Why? It's not the chance. It's not the chance. He is very close to the truth. The point is of this chart that, especially on the short side now, he wanted to sell and he is right, but we can also buy at 5 actually. We have, this is very important, this is what I look for. We have many consecutive bars in the same territory. Here, below here, I show it here because nobody says both screens. If I only had, here we have many bars showing losses. Okay? So from 7 up to 16, I know that in no case I would have made statistically money buying at any single hour. Statistically, I know that if I sell at 7 and cover at 8, I make money. If I sell at 8 and cover at 9, I make money. If I sell at 9 and cover at 10, I make money statistically. So why should I sell at 7, cover at 8, sell at 8 and cover at 9? Would be better to sell at 7 and cover at 9, right? You are not convinced? You go to a restaurant. You go inside the restaurant. You sit down and eat a plate of pasta. Then you stand up, you go outside, you go back in, you sit down and you eat a steak. Then you jump out again, you go out, you go back in and you eat a dessert. Is this smart? Maybe a little bit because you move all the things you're eating, you need to put wait a bit. But the easy thing is you go out, you sit, you order pasta, you order the steak, and you order the dessert, and you eat all of three. Same thing here. Why should we sell at 7, cover at 8, sell again 1 second after, cover 1 hour later, sell again immediately? We just stay in the position. Having consecutive bars showing a bearish behavior, because this is a bearish behavior, I was entering long and I was losing money, always. This means that there is a bearish behavior, because if I'm long and I lose money, the market is bearish. So the behavior of this market is bearish inside a long period of time. As he said, I sell at 7 and cover at 3, I don't remember exact dates. But I can stay in the market short for a number of hours because I expect a tendency in all those hours to go down. The fact that the bars are consecutive and important, big bars, not small bars, shows me that there is actually a tendency to go in that direction. It does not mean that the market always went down and the market always went up. No, obviously not. Would be too nice. But there is this tendency, and we have to check if we can take advantage of this or not. If I had here the same chart, but with a loser, a winner, a loser, a winner, I would not go on in anything. I would not like it. Because I don't, a single bar, why is the single bar from 5 to 6 no good? This was the question I asked you before. Probably it is not good for a simple reason. Because in 1 hour, the market would probably, might be bullish, but not enough bullish to give me enough profit. In fact, this is with one lot, 100,000 size, okay? We made, let's say 8,000, okay? $8,000. These are 4 years. 4 years are about 1,000 trading days, right? More or less. So we have about 1,000 trades. 1,000 trades, 8,000 profits. $8 a trade in average. $8 with a pip value which is $10. Because one lot has a pip value of $10. A pip at the 4th decimal. You are biased because you are from TMS, you know the pips. It is clear. I measure the pip at the 4th decimal. 105.10. 105.11, okay? From 105.10 to 105.11 is $10 when you invest one full lot, as in the case here. Making an average of $8 per trade with a single pip value, where your broker can be the nicest person in the world, but he's working for business, and he will not give you a 0 pip spread with no costs. So you have to pay somewhere something, either a spread or some commissions, depending on the offer of your broker. And those $8 gains are easily gone once you have to pay your trading costs. So a problem from 5 to 6 or from any single hour here going short is that the single hour does not move enough. It moves, but not enough to cover our costs we have to pay to the broker. While having consecutive hours of a downtrend behavior, we can expect to have also larger moves. And if the moves are in average larger, our average trade will be larger, and maybe we can cover the trading costs. And this is what happens here. Now, we don't need to analyze this on the chart, but we can imagine to enter long at 5, as somebody said, but to exit the long at 9 o'clock p.m., where the big down bar comes. We don't want to stay in the down bar. Then we enter short at 7, and we close at 2. We could close even at 4, but at 2 we are already a weaker behavior, so we stand a little bit less in the market. This is what we simulate in our trading strategy. This is our first trading system. It's a system. Now, the question is, does it make money or does it not make money? And how does it look like year after year? This is the equity line. And in my opinion, it's a very good and nice equity line. Why is it good and nice? Because it shows consistency. It is more or less growing every single year it has been analyzed, which means the behavior that I saw to be bearish in this time window and bullish in this other time window, that behavior more or less has been confirmed every year in the last 4 years where I have the data available. I can tell you even longer ago because I tested also on other longer term data, of course. But is there something wrong? Are you happy with this? Euro dollar only. Yes, because wait, this is very important. Very important. I studied euro dollar because I'm trying to discover if euro dollar has a specific behavior. I'm not expecting this to happen on GBP dollar. Why should it be the same? Or on US dollar, Japanese yen? If I want to discover something there, I have to go there to look. If I want to know what you prefer to eat for breakfast, I don't watch his breakfast. I have to watch your breakfast. Yes? In any case, don't get crazy. I will send the expert advisor to TMS people so that they can put it at your disposal to be placed on MT4 and to develop further or whatever you want. You could even trade this on your own, even on the web platform manually, because the times here are pretty much human. If you had an entry at 2 o'clock in the morning, maybe it would be a bit more difficult to place it manually. But at 5 p.m., 9 p.m., 7 a.m., maybe the 2 is a bit problem if you are at work, but all the rest is feasible. But obviously, may I change the slide now? May I? This is, you don't know the platform of your broker. No, Singapore time was an example. This is Central European time in this case. TMS has the server of MetaTrader on Central European time. Obviously, when I investigate for a market behavior such as this one, and for any strategy, this is my specific approach, I always test without trading costs to start with, because first I want to see if a motor, an engine works, and then I see how good it is when it works. So if I run the same strategy with, sorry, I just missed one part. This was entering and exiting. I measured the outcome with a stop loss, okay? And in this case, we see that 700 stop loss is better than no stop loss. Zero is no stop loss, the way the strategy is built. It's good to see that from 400 up to 1500, more or less, the results are the same, which is very good. So we can easily choose 700 because we are not optimizing. We are just taking one of the values, a bit better, but are we comfortable with 700? Yes, no, we could choose another one. It's not a problem. But 700, which is 70 pips in this case, is a good stop loss just to avoid the worst case scenario where things go crazy and we lose a lot of money. So again, I investigated with the optimization and I choose the best, but only because I see a very high degree of stability with changing values. I don't see jumps from 700 to 800, for example. But I would be suspicious if I said 700, 64,000, 800, 40,000, obviously. But here the differences are so small that I can easily accept the 700 stop loss. Here is the equity curve once we use the more normal spreads that are offered by the broker. Okay? I run that test with the minimum 2 pips spread, 2 pips, which is 0.2 actually of the platform. Less than that is impossible. And this is with a current spread what you find on the market, okay? And it's still making money, which is fine, obviously. But the behavior becomes worse. I would take this. I mean, I would feel comfortable trading this. But obviously, if this were the only strategy that you had, you see many months, years here were with no profits. So actually you could feel a little bit difficult to accept it because you don't want to wait forever. You are not sure that you stay so long trading a thing that does not make money. And there is not much to do actually, because if we only consider this, it's not easy to do it. What we can do, as we are looking for a behavior, a reaction in the market to something, to see if for some reason, for example, this is just one example, you can go home and test anything you have in mind. If for some reason things change, if we put some conditions in the entries. And for example, we say, okay, I enter short at 7, I think, only if the close just before 7 o'clock was bigger than the close of 1, 2, 3, 4, I don't know how many bars before, things like that. This is one condition we can test, and the same obviously for the long, saying that the bar before the long entry was, in this case, smaller than the close of n bars before. This again is a test that I make, because I know, as a trader, with my experience, that most often entries after a retracement or a condition like this, I enter long only if the close is smaller than the close of n bars before, help. I know it helps, so that's why I go and test this. But you might test other things, whatever comes into your mind, because you have to be curious. So this is the meta quote, MQL code, but I mean, I don't want to frighten you. We see some example where the shorts with 1 means there is no real change, no real condition, and there are some conditions here, 5, 4, 6, which change a little bit the things. So here we can choose. 1, 1 is the original situation, no filter. Because I say if the close is smaller or equal to the close of the same bar, so actually there is no condition, true. And here I can choose either I have no filter or I use one of the filters here above. For example, taking the first with a 5 here, we have this, which is very similar to the original one, this one. Okay? Look at here, the difference is here, I think. I don't here. Look at this part here, okay? And now look at here. In fact, it's not there, the difference. It was here maybe, I don't remember now. This drawdown here. And then we have this one where we clean up here, but we have a worse period here. Look here, there is a descent. A small descent, which we don't have in the original curve. So actually, it is up to your personal attitude now to choose one solution or another. I would stay with the original one and put it into my basket of strategies. Absolutely. But you might look for something. The only thing I recommend, if you add conditions to clean the equity line, don't add too many conditions. Because when you see clean, you start getting excited. You clean too much, at the end you have an overfit system that has no longer anything to do with the original idea. So try to stay as flexible as possible, but don't add too much, because too much is not always good. Normally it is not good at all. This was an approach which I call on a bias strategy. Bias, where I try to see if there is a cycle or something that witnesses that the market is likely to do something in the same moment. I can tell you, DAX future again, normally there is a bullish behavior from 5 p.m. to 9 a.m. the day after. You could go long every day at 5 and close the long the day after at 9 in the morning, and you would make statistically money. If you did it on the Brexit day, you would have lost a lot of money. But in that case, that's the only case where the systematic trader should switch the systems off. Because you know that you are in front of something that is not statistical. Brexit is once in a lifetime, probably. So knowing that during the night you will get the result of such a referendum and that it probably impacts heavily the positions you have open, you can say, okay, I want to try to be lucky, or I better flatten everything, and tomorrow I start again from scratch. That's the best choice, obviously. I didn't trade DAX on Brexit. I switched all my strategies off. I switched also the mini S&P off, and the euro dollar and the British pound US dollar. All these had been switched off. Unfortunately, I left attached the euro bond strategies, and obviously I lost money because I didn't think about that, and I was hit on all the strategies that I had. It happens. But now, let's see another approach. Another approach, again, I show you how, with step-by-step investigation of a market, I try to pull out something that works from the market. Why only the best? Because here we talk about filtering trades, which I recommend not to do too heavily, but we do it hopefully in a clever way, and to see what happens when we do this. As I said this morning, that some markets have trending characteristics, some other mean reverting. And when you look at the trading model, you have to be aware of it. And don't be stubborn in looking for a solution where it is hard to find this solution. Try to look for a solution where it works probably better. Let's imagine this. Daily bars, okay? Daily bars. Let's imagine the simplest approach possible. We enter long if there is a breakout of the high of the day before. We enter short if there is a breakout of the low of the day before. Okay? Is this clear? We don't do it in MetaTrader style, we do it in trading style, which means that if we are long and we have a short signal, we close the long and reverse to the short. So actually we sell two contracts. We are always in the market, but either long or short. We don't have long and short positions open as MetaTrader allows, which is a bit crazy, but it's what the platform does, so we have to be aware of it. But this is now only for investigation. We imagine a simple strategy where you say, I buy on daily bars if there is a breakout of the high of yesterday. For example, here, this is the bar. High of yesterday, here, there is a breakout, I enter long. I stay long, and here there is a breakout of the low, here the low of yesterday, I enter short. Here I enter long, here I am losing a lot of money, here, oh yeah. Here I enter short, here short, sorry, there was long, and I make a lot of money, and so on. This is a strategy. Obviously, we expect this model to work better on trending markets and to work worse on mean reverting markets, which is common sense. Let's see if it's true or not. Do you remember what a trending market is and what a mean reverting market is? Two examples. Mean S&P is mean reverting. Trending market example? Crude oil, gold, also DAX. It's changing a bit, but also DAX. Here are the results, okay? Results, starting in 99, okay, but it doesn't matter that much actually. So we have, I already ranking this in from the best to the worst, okay? Gasoline, which is very similar to crude oil, but it is more volatile because it has smaller volumes. So it is even reinforcing the trending behavior. Natural gas, gold, heating oil, again, very correlated to crude oil, but more volatile. Then we have crude oil. If I only had the mouse here, crude oil. Wait. I have a powerful tool here. What is the laser beam here? The green one? Okay. Yeah, but I don't see the screen. Crude oil, gold, soybeans. Crude oil, no, it's not those gold. DAX, this is DAX. Soybeans, British pound, FIB. The last one, the bottom one, mini S&P 500. ES is mini S&P. ES is mini S&P, which is losing a lot of money. So this confirms the tendency of this market. The mini S&P does not work on breakout. This is clear. Easier than that. Look, it's the worst outcome here. While the best are markets that I know. Obviously, if now I want to develop a trend following strategy, I will choose among the first there. I will never take the mini S&P. Why should I take the bottom one? It loses so much money. But in any case, these are the results. This is the simplest approach possible. The questions are if there are limits to the method, and if we could improve it, because we saw losers and maybe the results were not tradable, maybe. This is the equity line. This is of DAX, I believe, 50K. Wait, just 1 second, please. Yes, DAX was 53,000 euro, and this is the equity line on DAX future. Would you trade this? He doesn't want to trade it. Who was there? I don't hear you. Maybe up, but yes, it's up. It make money, but would you trade this? Would you put this live with your money? I wouldn't, but maybe I don't like the DAX. I don't know. But this is a crazy equity line. It's jumping up and down as crazy. This is something that makes you mad. So I don't like this to be put live with my money. We have not put any stop loss so far, nor take profit. Let's imagine to put, in this case, parametric stop loss and take profit. Why am I putting parametric stops and profits? If I use parametric stop and profit, I can use the same model on all the markets, because being parametric, it doesn't care about the market side, but only about the single moves of the market. If I say take the stop, which is 3 times the average range, for every market takes the average range of that market, it puts the proper stop in that case. But just a note to, and then take the last 5 days, which is one trading week, makes sense. I can take, this is an example again, half the average range of 5 days as a stop loss, and 2.5 times the average range as a take profit. For example, here are the new results. Mini S&P is still down there. But look at the DAX. Okay, we have now 146. You remember it was 53,000? Now it is 3 times, more or less 3 times as much. So this is a good improvement. And it also is a logical improvement, because I would not like to trade anything without a stop loss. Here I have a reasonable stop loss in place. I like this, so I will certainly do that. So we can go one step further. And as we now focus only on the DAX, we fix these numbers here. So you can write. Wake him up, please. And You can write the numbers. We have a stop loss of 40 points, which is equivalent to 1,000 euro on the DAX future contract. Take profit of 250 points, which is equivalent to 6,250 euro on the DAX future. And a trading stop, which normally does not improve performance, but can help psychologically, of 120 points, 3,000 euro on DAX future. We tested with these values, and we get an even better result with 270,000 euro gain from 99 to, which is end of 2016 when I first tested this. An average trade of 103 euro and $60,000 drawdown. Let's see the equity line to have a clearer idea. For sure, this equity is smoother, let's say, than the previous one. But again, I ask you the question, would you trade this? Who is trading this? Okay. No. Why is he so courageous and you are so... The problem is that in the low volatility years, but also in the high volatility, look at 2008, it didn't go anywhere. So you would have stayed through 2002, 2015, about 12, 13 years with no gains. Again, if you have, like me, 80 strategies, maybe you don't care, unless all 80s don't make money. This is a bit dramatic. But if you use this one only, and maybe the previous on Euro, it's too long a period with no progress, and you get disappointed. So I'm not yet satisfied with this. And here we go. I was wondering what he is reading with such an attention. I put a filter based on market acceleration. What does it mean? Imagine that you are running after a bus, because you have a bus stop there, and you start running to catch the bus. When you are close to the bus goes away, and in that moment, a thief takes your wallet and runs away. You already run too much to catch the bus, and you are too much tired. You don't have any sprint any longer. You cannot run after the thief because your legs hurt. You cannot breathe anymore. Your wallet is gone. If you are walking, resting, the same thief comes, you are fit and strong, you run. Normally the thief is faster, but let's visit an example. you are at the beginning, at least, you are a bit stronger than when you were tired. Also, if you go the one night to the disco and you dance, the next day you run a marathon, I believe you will not get the best outcome. While if you have a proper rest after your training and you go and run the marathon, by the way, tomorrow is the marathon, so don't go to the disco tonight, then you probably have a better result. The same happens in markets. When a market has too strong an acceleration, it is unlikely that in the next future it will still go very fast. This, in a certain sense, might be the opposite concept than the momentum trading, but it's not, because the momentum trading shows an acceleration in the market, you enter, but you go for a long run. You see, this market is showing strength. I enter, and then I wait for it to develop. Here, you are trying to get shorter time profits, so you have to take advantage immediately of your entry. And when you enter in a market that already ran too much, the last 2-3 days, for example, it's much harder to see that run continue in the next 1 or 2, 3 days. Just because it accelerated already too much. To study the acceleration of a market, we can use the ADX indicator, or oscillator, better said, which goes from 0 to 100, but don't use the standard ADX that you find on MetaTrader. I will send you the right formula together with the expert advisor built for this, because the smoothing factor of this one is better calculated. It's a Wilder formula, which is not always present in MetaTrader. So wait for mine to run the test. The concept is the same, but if you follow the numbers that I show, you need the same calculation, of course. But the point is that ADX goes from 0 to 100, and we can imagine to say, perfect, I enter long at breakout of yesterday, or breakout of the high of yesterday, or short at the breakout of the low of yesterday, only if the ADX is smaller than 5, 10, 15, optimization, 5, 10, 15, 20. If I see a behavior in this optimization, I can take advantage. If I see random numbers, I know it's not the right way to go. And I do see a behavior here. Obviously, 100 takes all the trades because you never have an ADX that big. And going down, okay, you lose performance. But look, at a certain point, going down, filtering trades, you get an improvement. Here still something less, but improvement. Then 35 is the best. 30 is worse. Is 30 really worse? Is my question. Because if the answer is no, it is not really worse, then we are in the right direction. If you say yes, 30 is worse, then there is something wrong in this. We are, as the title said, taking only the best. Okay? Obviously, we have to find a good compromise. 30 leads to a net profit of 266,000. 35, 376. So apparently, below 35, things go worse. So I'm filtering more, and is it worse? So maybe it's not the right filter. My question is it really worse? No. Okay, but why not? Where do you find immediately this information? I read this simply in the average trade, which is net profit divided by the number of trades. So here I see how large, in average, is each trade. And actually, with a filter of 35, my average trade is 311. But it becomes better with 30, even better with 25, even better with 20, and very good with 15. The only problem is that I filter so much that I don't trade that much. So I'm making less profit simply because I'm trading much, much less. But the trades that remain active are all, in average, better. So the quality of a single trade is much higher. The single trades that remain after filtering are better, stronger. I get larger profits from the single trades, but I trade less. So I have to find a compromise, and actually the best compromise is to put the limit at 35. I have good trades, I'm going in the right direction, but if I filter more with a more strict rule with 30, then I'm filtering also some good trades, weaker but still good, so I don't have a real advantage. So it's better to stop at a certain point. I filter just something. So maybe you go on a diet and you decide not to eat cakes, pudding, chocolate, sweets, bonbons. You filter everything. Yeah, effect may be better, but what a life. So maybe you say, okay, I take a brioche every morning and I filter all the rest. I'm still happy. I still lose weight, but also I'm a bit in a better mood. Same here. I know that filtering more with this concept helps. The quality of a trade is better. But being the quality of the 35 filter trades already very high, and having enough trades to get more profit, I don't see a real reason to give back about 20% of my profit just to get a slightly improvement in the quality of the remaining trades. And I would stay with 35. Andrea Unger. If you say, no, I want the best quality because I have 355 strategies, so I don't care to filter this very much, okay. You know from these numbers that the ADX filter is a powerful filter to identify the better entries. Those entries where it is more likely that the immediate behavior after the entry is in your direction. Just because with a low value of ADX, the meaning is the market was relaxing, smoothing down, keeping calm, and once it breaks, it has more energy to immediately go in your direction, which is what you are looking for, obviously. Yes. This was the DAX breakout of high and low with stop of 40, take profit of 250, trading stop of 120. Or low, high or low, yes. Now, obviously, we've improved the numbers, and so we still have to see if equity line is better or not. And I would say it definitely is. This is something I would trade. I don't know you, but I like it. Please tell me that you like it, because I'm speaking for the last half an hour about it. This is the result with the DAX CFD, which is obviously worse because the conditions are generally worse, but it's still making money. So it's absolutely tradable. But I will show you something more after the next 15 minutes, where we will be talking about position sizing, money management. So refresh your mind. Stay tuned. We have just only 20 minutes to go, when you can forget all your sorrows in the whiskey. But for now, I don't drink alcohol, so I will leave you. So if you have questions, ask them now. Money management. So the question is, apply money management means to always use rules such as always use a stop loss, have dynamic trailing stops, have a good risk-reward ratio. I think you all heard these things in the common sense rules for trading. Is this money management? No. This is risk management. It is something which is good, absolutely, good rules, but it's not money management. Money management means to calculate how much one lot, 0.5 lots, 0.7, 1.2, how much shall I invest in my next trade? Money management gives you this kind of answer. We have two basic approaches in trading: martingale and anti-martingale. Who knows these names? Many people. Generally speaking, martingales increases the size after a loss, and anti-martingale decreases after a loss and increases after a win. This is the general rule. Martingale is based on the belief that after a loss you have a higher probability to have a win. If you go to the casino, you play black and red. Maybe you wait for a losing strike on reds, and then you point everything on black. I did it when I was young, many years ago, in Salzburg. I played. I was starting with 250 shillings, where shillings were very at the time, And I arrived to 900 something doing so. So I said, okay, my last bet, I get over 1,000, then we go to the disco to have a party. And I got 9 reds in a row, losing everything. The only wise thing I did not change extra money. I just said, okay, this is done now. Let's forget about it. Anti-martingale goes with a trend. And actually, you can use the same fixed percentage on every trade because it's the same thing. Because when you have less capital, you apply the same capital, you are risking less because you have a smaller basis on which you calculate your capital, your percentage on. Let's run a simulation. Head or tails. Now, you're not costing the toy row here, but I made this in Excel. 100 tosses or 1,000 with a starting capital of 100. In the simulation, we imagine different scenarios where we start with martingale at different percentages, 1, 2, 3, 4, and so on. And then, in one simulation, we decide to multiply the exposure per 1.5 after a loss. In another, we multiply by 2. We double the exposure. On the contrary, anti-martingale, we start with similar starting points, but we keep them constant throughout the history of our game. So martingale, we increase when we lose, either per 1.5 or per 2. And then once we win, we go back to initial value. So if I start with 2%, I lose, I go 4%, lose again 8%, lose again 16%, win, back to 2%, and so on. Anti-martingale, I always 2%, 2%, 2%, 2%, regardless of win or loss. Just because winning, I have higher capital, so higher exposure, because 2% of more is more, and the opposite for a losing case. And here are the numbers, okay? This is martingale. There are some Italian notes because it's from my book, so it's sorry about that. The first case, this is multiplying by 2 and this is 1.5. The first case shows winning percentage of 53% after 100 tosses, okay? What you see here is that we made money here. With 5% start, we got up to 1,000. 1,000, more or less. Then after 10%, we lost everything. So starting with more than 10%, we lost everything. The interesting thing that you have to notice is that in the second scenario, we had a 57% winning percentage, but you can see it visually, we made less money. You see it? We have only 3 cases where we have still money after 100 tosses. And the third is even we lost because we have only 24 euro left from 100. Then we lost everything. So it's very curious that a worse final outcome made me make less. A worse made me make more money than the best. I won 57% of the cases, but I have less money than in the other case when I won only 53%. Remember this. Then, interesting is also that the second box after 1,000 tosses, in both cases, I lost everything. You see? They're empty. Empty. No money left. No money left. In the second case, where I am the right boxes, I just multiplying per 1.5 instead per 2. So I'm less aggressive in this case. Same scenario that 53 makes more money than 57 because here I have more empty boxes here at the bottom, which means that I lose more money. Here is still money. And same scenario that after 1,000 tosses, I have no money apart from this small case here, but this is just started with 1%. So in general, I lose all the money. Now let's take the very same results and let's see what happens with anti-martingale. With anti-martingale, I interestingly have money. I lost here, but I still have money. And here, 57 shows better results than 53. You see here? This is much better than up here. So with an anti-martingale approach, actually, the better result in terms of winning percentage leads to a better result in terms of money. And another interesting thing is that after 1,000 tosses, I still have money in many cases, in some cases even a lot of money. You see here? A lot of money here. Then here I lost. Here I lost. Risking too much, I lost. So from this simulation, the first message I get is that using martingale, in spite of higher winning percentage, I can make less money. This is the first important thing. Actually, the reason is because it depends on how there is the consecutive wins or losses. But mathematical demonstration is not necessary. 1,000 tosses always led to ruin, which means that using martingale, in the long run, I lose everything. With 100, sometimes I make money, but going on, I lost always. And another message is that regardless of using martingale or anti-martingale, if I risk too much, I lose everything. You have seen the empty fields also in the anti-martingale after 1,000 because I was simply risking too high. So when you risk too much, you end up losing all your money. This is very important. If you are still not convinced about this, imagine this is your money, okay? You go with a first bet and you lose. So you go with a second, doubling your exposure and you lose again. Third time you double again and you lose again. Then you double again and you lose again. And now you have no money left. You cannot go on. This is the reason why martingale doesn't work. It would work only in case you had infinite capital, so that you could go on infinite. But I mean, you would be a bit stupid to play with martingale having infinite money. You have probably better things to do. So obviously, this is clearly done to state why I decide to use anti-martingale. Okay. So the question now is, okay, you said anti-martingale is better, fixed percentage, how much? Is there a better percentage? And if there is, how can I determine it? Maybe you heard about Kelly equation, optimal F. Are these the numbers? I don't know. Let's see. Kelly is a purely theoretical calculation. This is the formula. K is the percentage of capital to use in every trade. R is the average win to average loss ratio. And W is the winning percentage. Putting this together, you get a mathematical calculation of which the best percentage would be. But average, too many mean things here. It's too much statistical. And on futures, it creates even confusion because it tells you how much capital to allocate. But that depends on margins, so it's not even sure what to put in the market. And the problem is that it refers to size. It tells you how much to put, not how much to risk. So it doesn't start from the risk concept, which is what we want to look at. So a better approach could be the optimal F. The optimal F investigates on your trading history what would have been the best percentage to risk every trade to maximize your result. And if you do that and you run 1,000 tests or 100 tests, where you test with 0.1% risk, 0.2, 0.3, up to 100% risk, and you see how your end capital would look like, you would get a curve like this. Obviously, with zero risk, your multiplier is 1. Zero risk, you don't trade at all. You start with 100 capital and you end with 100. Just multiplier is 1. That nothing changes. Then the capital, the multiplier, starts going up up to a certain point. And after that point, which in this case, but this is just an example, is 37, and you multiply by 2.32 something, it goes down to 0. So here you see again that concept that in this case, with this history, the best percentage would have been 37, for example. Risking more than 37 produces worse results. So there is a barrier. It's not true that the higher you risk, the better the final capital. There is a point above which your expectation is reduced. The best result, the highest point, the percent that leads to the highest point is called optimal F, because it's the optimal evaluation of the maximizer of your capital. I don't want to tell you this because are there mathematicians here? No. This is the theoretical explanation, but don't ask me. I mean, I can do it, but you want to take a picture, confess. Don't do it. It's useless. It's very simple. You test. You can build it in Excel. You test with 100,000 percentage, and then you build the curve. You find it. So the question is, okay, so I have a Kelly or optimal F. Shall I use this? First of all, the statistical values, you don't have the statistical values of the past that can predict the future, obviously. The future can be different. And in any case, the behavior that has been in the past will never replicate exactly as is. Maybe even better, maybe. Normally it's not. But it's unlikely that you have exactly the same. It's not just the coin toss where 50-50% always. It's always the same. On trading, it's different. And real trading is disturbed by other events. You drop a coffee on the cupboard, or the cat jumps on your keyboard, or your little kid calls you exactly when you are placing a trade because he needs to pee. All these things, they happen. They do happen, and they disturb your trading. Not to mention internet connectivity breakout or things like that. So actually, what we end up in saying is that we highly recommend not to use these numbers. Don't use Kelly, don't use optimal F. So why should I have explained this to you if I recommend not to use them? The point is that when somebody starts trading, either, first of all, inexperienced, obviously. Everybody who starts something is inexperienced. And normally, who starts does not dedicate a large capital to trading, because they start small, obviously. But they are greedy. They think to become rich very quickly. And due to these motivations, normally a new buy takes excessive risk. So, knowing the numbers that you can calculate from Kelly criterion or from the optimal F gives you a clear idea, based on the strategy you have, what are the real barriers never to approach. If you get an optimal F of 12%, don't trade with 10, 8, not even 3, 2, maybe 1%, 1.2, divide by 10, but stay as much away as you can from that value. Because the closer you go to that, the higher the probability that you go broken. So it's important to know the physical limit. When I was trading the championship, I knew the optimal Fs of my strategies. And I knew that it would be silly, in any case, to place trades with higher risk than the optimal F. I had a worse chance to make a decent profit. I knew the limit of my strategy, the mathematical limit. So I didn't want to exceed that. It's useless to do more because we saw you make less money. So let's go back to the DAX now, the strategy that our friend wanted to know everything about. We can fix a percentage of risk. We decide to trade that strategy with a certain percentage of risk. And we base our calculation on the stop loss, 40 points. That is what we risk to lose. And we calculate exposure based on the capital. So we say, with 40 points, I lose 40. I have a capital of 1,000. 2% of 1,000 is 20. if I lose 40, I don't want to risk more than 20, I have to trade half a lot. Is that clear? Half a lot, because half of 40 is 20. As I don't want to lose more than 20, if I have 10,000, 2% is an example. I can allow to lose 200, 2% of 10,000 is 200. Then, losing 40 with a lot, I can allow to trade 5 lots. That's it. We do this optimization with different percentages of risk, and these are the results. The first line is the standard strategy with no single lot, and these are the results increasing the percentage of risk. So obviously, I see his eyes. They are pointing down here. He is greedy. Don't look down there. I recommend never to exceed 2% risk in any trading strategy. But let's see what happens here. This is what the result would be with 2%. It's very nice that you make a lot of money. Down you see the number of lots. But you already see that it is very, very like a roller coaster. It's not something that we can really be quiet about. And if we go a 4% risk, now he again has shine in his eyes. But this is the past. It's nice. Imagine, when I tell you 4% risk, I'm sure you believe it's a small percentage. But look how powerful it would be. It's incredibly powerful. It's the same strategy, the same model we had. The only difference is we applied position sizing. In this case, with 4%, which I don't recommend to use ever, unless you go for a championship, then you can do it, of course. Don't risk too much. 2% is enough. Okay, if you have only one strategy, only one, you can even go with 3% if it's a good strategy. But generally, if you have more than one, 2% is already aggressive. Believe me, 2% is aggressive. Plan to trade not losing more than 2% in every single trade you are placing. This, what you see here, is just an example of the power of position sizing. The reason why I studied money management, the reason why I wrote a book about it, is because I recognize the power of money management. And here is the evidence. Same strategy, simple strategy, not that difficult, simple concept, but this is the result that could show up if you apply money management. It's 6 o'clock. I thank you for having been here. All the material here, the expert advisors that we discussed here, and the Skilled Academy course that is for free will be delivered to you through TMS. Be careful that you will get a link to register to the course, the free course, but you have to do that before the end of May, because after that, that link will expire. It's not because I'm a bad guy, just because we have to be a little bit concrete in these things. While the advisors, I will say, once you register to the course is forever. It's lifetime. Once you are in, you can watch it when it's video course, or you can watch it whenever you want. But before the end of May, you have to click on the link and to register if you want it. If you are not interested, it's another point. And then I will also get the advisor. Just be patient, because this information will probably go out in May, because I'm still traveling this coming week, so I cannot send too much stuff because I'm not at home. This was it. Here you have some 1 year target is my website. Skilled Academy is the website about where the courses are, but once you register there, you get it, so don't worry. And I thank you, of course, and I want to thank TMS who organized this. I believe I'm here because I believe that TMS is a good broker, where good means a honest broker, which is so important, especially for me who passed through a bankruptcy. So I saw that their approach has been serious, and their concern was more towards the contents that you here would get from this rather than from pure promotion. So that's why I accepted the invitation, and I hope TMS will not change just after today. I believe not, but this means that all you who are here, who should be, I suppose, customers, are in good hands, in my opinion. So this is important because it's also part of the risk management process to choose the right broker. Thank you TMS, thank you for introducing me, and have a nice time.